This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
I mentioned in the previous chapter that an accounting period is normally 12 months long, but sometimes a company will prepare a short set of accounts, and sometimes the accounting period will be longer than 12 months. If that's the case, then it has to be split into two accounting periods, always first 12 months and then the remaining months, however many they will be. Now, if that's the case, and I have seen a Section C question where they have put in a corporation tax question where there is a long period of account, these are the rules that you need to apply. Now, a lot of this is common sense. So, if you have a set of accounts which are, say, 18 months long, you will have to time apportion them because you have no idea on what date the income was received or what day the expenditure took place. So it has to be time apportioned. Now, when you have time apportioned it, and obviously you would do 12/18ths and 6/18ths, you now have two accounting periods. You need a separate computation for each one. That one will be full allowances, and this one will be 6/12ths of written down allowances, etc., etc., because it's a short period of only 6 months long. Accruals basis. Now, if there's two things to this, if you've given a set of accounts, a set of details with no dates, you have to time apportion if you've got no dates. If you have dates, then you will prepare two sets and you'll put them where they took place, or actually in the dates that actually took place. That's got a date, that's got a date, that's got a date. If it's got a date, you know exactly where to put it, either there or there. So we've got one example, because that's the rules. Simple as, you get a long period of account, you have to time apportion it 12 plus. So we have here an example. A PLC prepares a 15th month set of accounts. The results for the period were as follows. We have adjusted profits, a chargeable gain, which took place on that date, and QCDs paid annually on that date. Dates mean you know where to put them. So the written down value of plant and machinery qualifying for capital allowances at the beginning of the period was nil. Capital transactions in plant and machinery during the 15-month period were a second-hand van on that date, a new plant and machinery, we know what that means, long life assets, we know what that means, bought on that date. So we're now going to calculate the tax liabilities for the relevant accounting periods. That is your hint. And it's always 12 plus. Alright, so let's check the answers and see how it goes. You see how the columns are set up? 12 months 2, and they've actually put the date in. That will help you as well as the examiner to see that you know the rules. So it's always 12 plus whatever the balance is. So this has been prorated 12/3, and it's been, so that's good. If not, working one, show your calculations. Two capital allowances, there's a working there, we'll have a look at those later. So we've done one for a 12-month period and one for a 3-month period. The gain, we have a date, therefore we can put it in the correct period. And that's why your dates are important here, because it took place in May 23, therefore it must have taken place there after March. QCDs, again you have a date, so you can put them in the correct place. TTP, everything's at 19%. That is your answer. These are your workings. I don't mind whether you put the workings first and then the answer, or the answer first and then the workings. Sometimes, I prefer to set up my pro forma, put in the bits that I can do, because there are some bits where you're copying the question in. So copy the bits you can do the easy bits, and do your workings underneath. You'll get marks for copying if you copy correctly. Only half, and maybe half for 2 or 3 things, but you will get marks. So you're actually establishing the answer and getting marks before you get started with the more difficult stuff. Always do the easy stuff first. So we've got 2 capital allowances computation. 1, see, the van was not new and therefore has no first year allowance, but you can claim AIA instead. So that's a full 68,000 there, and that has been inserted there, as you can see. Then we've got 200,000. Now look how it's been laid out. Make sure you label it correctly. So it's 130% first year allowance. I've seen it, look, I've seen it. Telling the examiner. Then tell him what the expenditure was at 130%. And this is your answer here in your capital allowances computation. Then the special rate pool, again, now this here, AIA, we have to time apportion it. So we're going to get AIA of 100% because that's better than the first year allowance. Again, at only 3/12, but that's okay. We've got sufficient there to be able to put that in. So 540,000 nearly wiped out all the profits there. So an example there, no extra questions to do, but you will find questions in your BPP revision kit, because the rules, these rules here, this one here, this one here, they could be multiple choice questions in section A, and I have seen a question with an extra long period like this in an exam, so you will find one in your revision kit.